The market is giving us conflicting signals. You've got recession fears on one side and a resilient consumer on the other. So our job for the next 1 to 2 weeks is simple. Cut through all that noise and find the actionable setups. Let's get right into it. Okay, let's break this down because this is the whole game. On the left, you have noise. This is the political drama, the speculative rumors, the media hype. It's designed to get a reaction, but you can't really quantify it. On the right, that's the signal. Hard earnings data, key technical levels on a chart, and real shifts in volatility skew. One is a distraction, the other is the foundation of a real trading plan. We are only focused on the right side of the slide. First things first, you have to map the big, uncontrollable risks. These are the headwinds we either have to avoid completely or actively hedge against. Now, let's get specific. In China, what's interesting is that Xi's internal military consolidation might actually push back the Taiwan timeline. That's a short-term de-risking event. But the much more immediate factor is what's happening in Ukraine. Reports are showing that Ukrainian attacks have taken out about 40% of Russia's oil refining capacity. Now, that is a hard number. It puts direct upward pressure on energy markets, and that creates potential plays in energy stocks or ETFs. All right, shifting gears to what's happening at home, we've got the ongoing government shutdown, now on day 23. This is one of those slow burn headwinds that just creates a layer of fiscal uncertainty over everything. And here's the number that matters. This isn't just a political headline. Historically, shutdowns like this create an average drag of negative 0.2% on GDP. Why? Because you get reduced government spending and it hits consumer confidence. It is a direct, measurable headwind to economic growth that has to be factored into any market posture you take. So, with those macro risks mapped out, now we can drill down and hunt for the specific time-bound events where a real edge might actually exist. Right now, the number one source of signal is corporate earnings, period. This is the calendar that matters for the next couple of weeks. We've got Waste Management on the 27th, then a big day on the 29th with Google and Canadian Pacific. S&P Global reports on the 30th, and then Disney's a little further out on November 13th. These are the key data-driven events you should be watching. So let's focus on a high-conviction setup, Google's earnings on October 29th. The bull case is pretty straightforward. Gemini AI traffic is up around 300% year over year, and their balance sheet is a fortress. But the bear case is just as data-driven. You've got OpenAI's Atlas browser as a direct competitor, the stock's trading at a premium with a PE of 25.6 versus its 5-year average of 21.6, and concerns about rising capex are very real. This is a clearly defined battleground with hard numbers on both sides. Now, contrast that data-rich setup with this. This is a speculative claim that had quantum stocks like IONQ and RGTI moving in the pre-market. Just look at the language. Potential. Might be looking. This is the definition of rumor-driven noise. It's not a tradable setup like Google. And this is the critical point. You have to understand the difference. This is a speculative catalyst. It is based entirely on a narrative, on a story, with zero verifiable data to back it up. The risk is incredibly high because the outcome is a total guess. You have to know what you're trading. Okay, before we translate any of this into potential strategies, we have to go through this standard disclaimer. This content is for educational purposes only. It's aggregated analysis from multiple public sources to help you stay informed and improve your own decision-making. Do your own research. This is not financial advice. All right, now let's connect these ideas to actual risk-defined option structures. For a big event like Google earnings, you know implied volatility is going to be high, which makes buying options outright really expensive. So to counter that, you use defined risk strategies to protect yourself from that post-announcement IV crush. If you're directional, bullish or bearish, but want to cap your risk, a vertical spread makes sense. If you just expect a massive move, but you're not sure which way, a straddle could play that. But you have to be ready for that huge IV crush risk. And if you think the market is completely overhyping the move, an iron condor is a neutral strategy that profits if the stock stays in a range. The key is always to match the structure to your thesis and the vol environment. So the whole strategy here really boils down to a two-pronged approach. Step 1, hedge your macro risk. Use broad market index puts on something like SPY or QQQ to protect the portfolio from any shocks from that geopolitical or fiscal noise we talked about. And then, step 2, target the micro catalysts. You isolate these specific high-signal events like earnings where you can form a thesis based on hard data, not on rumors. Okay, let's pull all this together into a final, coherent market posture for the next 1 to 2 weeks. Look, the key takeaway here is discipline. The macro environment is defined by measurable headwinds. The micro catalysts are right there on the calendar. So a rational plan focuses on the data-driven signal coming from these earnings reports and simply uses all that macro noise from geopolitics in Washington as a guide for your hedges, not for your main thesis. And we'll close with this. This is not trading advice. It's just a market update to keep you informed. Markets carry risk. You need to trade your plan, manage your downside, and verify all the data yourself.